Let's turn now to the big take story. We love the big take stories that come out every day from Bloomberg News. Deeply sourced, just great, fascinating stories, really well done. This one goes to Wall Street's balance of power is shifting. Big banks are roaring back as regulation eases, lending surges, and private credit giants lose some of their luster there. Bloomberg's Katherine Chiglinsky helps lead our investing coverage. She is a pride of the William & Mary University, but she leads our coverage on all that stuff and investing in banks. She joins us for more. Talk to us about kind of the big banks. Like when I graduated from business school, went to the Chase Manhattan Bank, we did leverage lending, we made a fortune. And to see private credit take some of that business away, it really surprised me over the last 15 years or so. How's that balance of power these days?
Well, it was huge. I mean, it was a huge shift to see all these private credit, private equity firms sort of really taking all this market share away from the banks, as the banks, post-financial crisis were sort of limited by regulations, and also were arguably trying to be a lot, safer overall. But now we're actually seeing it change a little bit, and I'm not trying to say, banks are going hog wild on everything, but like they've been involved in a lot of the leveraged loan deals this year. We've seen them in some of the major acquisition financing, and it's been a good year for the banks. I mean, regulations have pulled back. JP Morgan's on track to have its highest annual profit. So it's actually been a pretty good time now to be a bank. Yeah, the balance has really shifted.
It's revenge of the banks, is how Mike Mayo, well-known bank analyst over at Wells Fargo, put it. These non-banks, though, do they, in return, perform less well, have less of the pie? How does ultimately it distribute itself? Because also, just the sheer scale of non-usual assets or alternative assets has just grown exponentially to like 16 trillion.
Grown exponentially. So obviously, I still think those firms will be fine overall, but you're really seeing the stock price talk a little bit. So like the bank stock prices are up quite a bit. I mean, Citigroup, we had their price to book ratio climb above 1% for the first time in a very long time. Like, I think you're starting to see them sort of get their mojo back a little bit and really find the groove in the businesses that they're, digging deeper into, investment banking, trading, et cetera. But I also think you're seeing, I think you'll still see these private credit firms, work really hard and find different deals. But I do think it's more challenging. I mean, we've had that whole, I feel like this year it was the credit cockroach debate.
Yeah.
Yep, exactly.
That really reigned for a long time. And while some of the banks were involved in some of those cockroaches, like First Brands, I think there is this growing sense that like maybe we should scrutinize a little bit more of these deals. And obviously the alternative asset managers got so big in the private credit space for so long that I think there's a little bit more of a scrutinizing eye on those.
Well, I mean, even in the Warner Brothers Discovery deal, there's a lot of big banks, bridge loans. I mean, bring back terms we haven't heard in a while. A bridge loan, which will be refinanced with a bond deal or something like that. Some of the traditional M&A financing seems to be coming back. But these private credit folks, they're not going away, because the money continues to flow into that asset class.
Yeah, the money continues to flow, and I think every competitor of a private credit firm really understands that, they're not going away. Like, you should be very careful. You are, if you're a bank for these financing deals, you're going up against a lot. I mean, yeah, you look at the Warner Brothers situation. I mean, the amount of firms that were involved in each of those bids, it's kind of crazy to say. It was banks, but it was also private credit firms and alternative asset managers.